Normal people with common sense would think, hey, I've got this little collection on my credit report for $50 because I was at a doctor's office and I forgot about my copay. I'm going to go pay my collection. That is the number one thing I wish more people knew, that paying your collections off, Brian, actually 9 times out of 10 will drop your score.
Yeah.
And that's because when it comes to collections, the credit bureaus don't recognize numbers. All they're paying attention to is how many collections you have and the age of a collection. So there's no difference between a $0 paid collection and a $10,000 outstanding collection. They're looking at the date of last activity. And once you pay that collection, you re-age the debt and then it stays on there another 7 years. So we know that people want to do the right thing, right? And they want to get in a better position. And so there's misinformation all over the internet. And so they go and do it, and then they hurt themselves, and then they come back to you and say, hey, Brian, guess what? I paid it. And you're like, oh.
So lesson number 1 today, stop trying to do the right thing. That's what I heard.
I think that's exactly it.
Welcome to the Uncensored Real Estate Podcast, where nothing is off limits. If you're interested in buying, selling, or investing in real estate, and you want to learn some of the insider secrets and uncensored truths from the true professionals in and around real estate, you've come to the right place. Now, let's buckle up for the uncensored truth about real estate and join your host, Brian Cardenas.
All right, everybody, thank you very much for joining us here on the Uncensored Real Estate Podcast, where nothing is off limits, and we like to bring in professionals from the real estate industry in and around it to try to talk about what's going on, what do people not know that they should know. And one of the big things that is an issue for people when it comes to buying a house is credit. And so we wanted to bring on an expert today to talk about credit, clear up some of those misconceptions that people have about credit, and just how much does it affect your life? Like, not even if you're buying a house. So like, as usual, when we bring people on, we like to talk to people who know what they're doing, because there's a lot of people in our industry that don't know what they're doing. So we brought on Paige White with Rescore Your Life to join us today to talk about credit. Welcome, Paige.
Well, thank you so much for having me, Brian. And I will tell you, I know you say I'm an expert, and I think I am, because my years of experience, but the stuff that we continually learn in our industry, even on a daily basis, is surprising, because things change a lot. So I'll try to give the best knowledge I can and information I can out there for you.
Well, everything gets outdated pretty quickly, as things evolve and change. It's just like us, we quote a rate to somebody today, and like by this afternoon, it may not be applicable anymore. It's so volatile. So
well, that was 5 minutes ago.
I know, it's no longer any good. So what I always like to start out with is just kind of asking a question, and I think it's really applicable to what you do with helping people with their credit, is what is something that people do not understand about credit that you think they really should understand?
Oh, well, I will tell you my number one thing. How about that?
Yeah, let's start there.
So normal people with common sense would think, hey, I've got this little collection on my credit report for $50 because I was at a doctor's office and I forgot about my copay. I'm going to go pay my collection. That is the number one thing I wish more people knew, that paying your collections off, Brian, actually 9 times out of 10 will drop your score.
Yeah.
And that's because when it comes to collections, the credit bureaus don't recognize numbers. All they're paying attention to is how many collections you have and the age of a collection. So there's no difference between a $0 paid collection and a $10,000 outstanding collection. They're looking at the date of last activity. And once you pay that collection, you re-age the debt and then it stays on there another 7 years. So we know that people want to do the right thing, right? And they want to get in a better position. And so there's misinformation all over the internet. And so they go and do it, and then they hurt themselves, and then they come back to you and say, hey, Brian, guess what? I paid it. And you're like, oh.
So lesson number 1 today, stop trying to do the right thing. That's what I heard.
I think that's exactly it.
Yeah, I mean, we see that a lot. One of the things that we hear about when someone comes to us or talking about trying to get a mortgage to buy a house is, I'm working on my credit. And it's like, hey, stop trying to work on your credit yourself, because what you don't realize is you can hurt yourself trying to do what you think is right more often than you're actually helping yourself. Isn't that right?
Oh, absolutely. Another thing that people don't know is, well, there's a couple things when it comes to doing your own credit. One is that when you like disputing things over and over and over again, and you're not doing it strategically with specific dispute reasons, then you're actually, the credit bureaus can actually write it off as frivolous. Once they are allowed to write it off as frivolous, they never have to respond to you again. And
Oh, wow.
so, yeah. And then the other thing is, when you go online and you dispute, there's a clause that people don't read because people don't read, that says if you dispute online, you're actually giving up your legal rights to sue them or arbitration if there are some errors. So if somebody is going to dispute, they always want to make sure they do it in writing.
Oh, wow.
Yeah.
So never use the online dispute process, basically, is the thing I'm hearing from you.
Well, going back to what we said, if you want to do the right thing. Yeah, I don't recommend it because you are giving away your rights. So just mail it in.
Yeah, I mean, the fine print that we all sign away when we're clicking on buttons saying we agree to terms and conditions, stuff like that, is just amazing what we're agreeing to. We don't have any clue because we don't take the time to read.
Yes, you can have my firstborn child. Okay, well, I didn't know that was in there.
Someone might offer that up without a problem, so that might not be that bad of a deal for them. So the collection thing, we see that a lot, and what we also have heard in the news lately is there's some changes coming with regard to medical collections. Can you kind of talk a little bit about that?
Yeah, absolutely. And that's going to be definitely a huge benefit to all of society, and definitely you as you for a lender aspect. So the change that they made a few years ago, oh man, maybe even 5 years ago at this point in time, medical collections used to be allowed to be reported after 30 days. Well, that doesn't give the person time to even pay it or an insurance company to pay it. So they said, okay, that's not fair. They changed it to 6 months. So it is important to know that although this new law is going to come into play, it doesn't mean that medical collections are never going to report. It just means that now they won't report for a year. So now you have more time to pay it and more time for your insurance company to get it right. So that's one of the changes, is they're saying that medical collections under $500, Brian, as well, under $500 will not report after the year. They're also saying that paid $0 collections will be removed off of your credit report. So whereas I was just telling you earlier not to pay your collections, the way this is written and stated is that once you pay it, it will be removed. Us in the industry are very weary of that. Time will tell.
Collection agencies are generally really, really good at deleting things and correcting things after they get paid, aren't they?
Oh, so good.
Yeah, I think that was the biggest thing that I was worried about. It's okay, they're supposed to take it off, which I think, for the consumer, it gives you a way to make sure that it gets taken off. But by default, I don't think it's safe to assume that just because you make that payment that it's going to come off, because chances are they're going to leave it there for a while because they don't care. They don't want to do the extra work.
Yeah, you're correct. And they don't abide by the law all the time. Yeah. One thing that most people don't even realize is that veterans, if they have insurance through the VA, also medical bills are not supposed to report. No medical bill is supposed to report if you're a veteran and you have insurance through the VA. And that is not abided by at all.
Wow, I didn't know that. That's a good thing to know.
And another thing that's important to know, just for knowledge sake, more than anything, is a lot of collection companies. Okay, so collection companies in general have to pay the bureaus to report, right? Every company has to pay the bureaus to report. That's how they make their money. So what happens is, let's say you have a collection with portfolio recovery, and you have 10 collections with portfolio. Well, they may only report 2 of them because they don't want to pay the bureaus for the other 8. So what's going to happen is collection companies, they're going to make their money. They're going to find a way to circumvent this new law. So instead of, now that they can't report the medical as much, they're going to report more of the other ones. That's what we think is going to happen. at the end of the day, I'm not trying to put a downer on this because it is really going to benefit us as a society and you as a lender. It absolutely will. I just don't want people to think it's going to be a blanket clean slate. That's not going to be how it works, but it'll help for sure.
Yeah. So how do the changes that we're talking about potentially impact credit scores? And maybe the better place to start is just talking about credit scores and like what are the differences in the types, because that's another big thing that we hear all the time when somebody's thinking about getting a loan. It's like, oh, I checked my credit and my credit's 750. It's like, okay, where did you check your credit? So can you kind of talk about the different credit scores that are out there and why they're different, and then maybe the different types of FICO scores too?
Sure. So there's a Vantage and there's FICO. So a Vantage score is what you're going to get when you go onto a credit monitoring site. And there's nothing wrong with them. They're just not your real scores. So when you're looking at a credit monitoring site, you're just paying attention to really what's in the body of the report opposed to the actual scores. Or you can say, this is my starting score. Even though I know it's not my actual score, it's where I started. So I want to see improvement. It's just a different scoring system or an algorithm. So many, many moons ago, if you can remember back to when credit bureaus first started, I mean, I know I'm old enough. Well, they actually went to the government and they tried to talk them into using Vantage over FICO. And they're still trying to get the government to use Vantage over FICO. And the government said no. So that's actually how credit monitoring sites came about, because they had to recoup the money they spent on these Vantage scores. So then they have the credit monitoring sites, and then now they recoup their money. So it's important to know it's a different algorithm. So I would say for as long as I've been doing this, they're about 40 points higher than your FICO scores. Now I've seen it both ways, so don't quote me on it. Don't hold me to it, right? But for as long as I've been doing, on average, 40 points higher. So if you see Credit Karma says you're a 640, you're probably a 600. Okay, so then yes, what are the Vantage or what are the FICO scores? So as of last checked, I think there's 53 or 56 versions of FICO.
Oh,
now,
wow.
That doesn't mean it's FICO. It doesn't mean there's FICO 1, FICO 2, 53, 54, 55, 56. Right. What it means is they've tried to change the algorithm within different FICO versions. So right now there's 10 actual version, 10 FICOs. But FICO 2 might have 6 different versions. And FICO 3 might have 2 versions, and FICO 4 might have 7 versions, and FICO 5 might have 8 versions, just a total of 56 throughout those 10. Okay. So when you go apply for an auto loan or a credit card, those are versions 8 and 9. So they are paying way more attention to, when you apply for a credit card, they're focused in on credit card history. When they're going in for an auto loan, they're focused on auto loan history. And you guys use versions 2, 4, and 5. And so when you guys do a mortgage pull, they're looking at everything. So you're graded much more stringently. So even your FICO, when you go to get a car loan, is going to be different than the FICO you pull, because the algorithm it's graded different. It's going to be challenged different. So remember years ago, Brian, they tried to, same thing, medical. They actually came up with a version of FICO that said medical is no longer going to be included into the algorithm.
Right.
Well, that only works if the mortgage industry decided to purchase and change out the entire system and go adapt to the new FICO. And they're like, no, go kick rocks. So it never went into place.
Yeah, that's the hard thing, is that, as a consumer, we don't know, or they don't know most of the time which FICO version they're getting. They may get their credit card and the credit card may actually have a FICO score instead of a Vantage score.
That's right.
And it's generally pretty close, isn't it? I mean, when you're looking from FICO 8 or 9 to 2, 3, or 4, I mean, there's going to be a variance for sure. But I mean, my experience is probably within 15, 20 points. Is that kind of what you see?
Absolutely.
Yeah, and that gives you a better idea. So like one of the things that I recommend that our clients do, especially when we're talking to people who are looking to get a jumbo loan, one of the things that people don't understand about what we do in the mortgage industry is when someone comes to us and we're talking about what their scenarios, what are they looking to do. If we're talking to somebody that's in a conforming or government loan price range, we know that we can pull their credit, see where their scores are, and then help them work on that if need be through working with you or just some pay down of debts to do a rapid rescore on their credit. And then we get to use that new credit score. When we get over those conforming loan limits, which for us is 647,200, we're into the jumbo world. Well, the jumbo lenders, I don't know why, they're smarter than the government lenders. They say that when we pull credit for a mortgage, that's the one we're using. Like if you try to do a rescore by paying down some credit card bills and then pull a new credit in a month, we don't get to use that one. We got to go back to the old one. So one of the things that I've been doing lately for people when I know they're going to be in that jumbo price range is I actually have them go to myfico.com. Mm-hmm. And that's by the Fair Isaac company. And you get all those versions of the credit scores. Tell me like your experience with that site.
We do the same thing. I always tell people, if you want your real scores, the only way to do it is have a lender pull, which is going to be a hard inquiry, or go pay $45, not even a month, one time, $45, go to myfico.com and you'll get your real scores. We absolutely encourage that if they need those real scores, so they don't go into something without being fully knowledgeable.
Yeah, I mean, when you get that one time, they've even got some basic simulators in there too, where you can go in and, play around with, well, what if I open a new account? What if I pay down balances on things? What impact does it have on my score? And it's been really helpful. Like we just had a client where they had good credit, but they were only probably, I think, 8 points below the next cutoff for better pricing. And all they had to do was, I think it was pay down like $1,200, which for them was no big deal because they paid their credit card off every month. It just so happens that what was reporting at that particular interval was a little higher than we needed. So we paid it down. We waited about 2 weeks. The new lower balance reported, we pulled his credit, and it was a 0.5% difference in interest rate.
Holy moly.
So it was really well worth it. I mean, I think it was $40 for them or whatever to do that MyFICO, right. But it was going to save them a ton of money on a big loan, 0.5% lower interest rate.
Mm-hmm. So that is very impactful for sure.
Now, the other thing that I think people misunderstand a lot is you see a lot of the advertisements on TV for Boost My FICO. Like, talk about that and the relevance to getting a mortgage.
Yeah, absolutely. I'll just talk about it in general. We don't recommend it for a couple reasons. One is what people don't understand when they sign up for Experian Boost. Well, one thing that it only reports to Experian. So you're only helping one bureau.
Right.
But when you sign up for Experian Boost, you are literally giving them your login information to your bank, your personal bank information. Now, they say they only use it one time, but I don't feel real comfortable about giving Experian my banking login information. I'm not sure about you, Brian.
Nothing can go wrong there.
No, nothing. And you are actually giving them the ability to sell your information as well, because what they're tracking you is what they're doing. They're tracking your expenses. So they're tracking your utilities. Mm-hmm. They are. And everything else you spend money on, and they're going to sell it and they're making money on it. So that's enough of a reason. But above and beyond that, it actually does not calculate into mortgage FICO. It will go into the 8 and 9. So it can affect, if you're trying to get a boost just so you can get a new credit card or a car, it will help Experian on those versions. But also it only helps people with very thin credit profiles. So if you have nothing, then it'll help you a lot more than if you have established great credit and you go out and do it. You're going to do all those things, give up your rights, your information, and get a couple points. For somebody that has zero credit, they may get, they say talk about 100 points. I don't know about that, but I don't know.
Yeah, I think we saw somebody had a pretty big jump in it because we actually had talked to them before. But what people don't realize is a lot of the time for several of different loan products out there is if we see on somebody's credit report that they've got all these utilities reporting through that Experian Boost, we got to make them go turn that all off and then have us repull their credit. So it's really nothing that's helpful. Like you said, it may be to get credit cards, it might be helpful, but other than that, if you're thinking about buying a house or refinancing a loan, there's just absolutely no benefit to it at all.
Again,
So,
information like you were talking about before, is just there's so much out there.
Yeah. So like you mentioned about having a thin credit profile or not having a lot of credit. What are some of the best ways for people to start building that up so that they can start to qualify for, credit cards, car loans, mortgage loans, stuff like that?
Sure. The fastest way to do it is gonna be get it added on as an authorized user to like if you have a family member, their card, it doesn't count as much as your own card because an authorized user just shows that somebody else knows how to pay their bills. But it actually can help give you some points, but you need to make sure that they have super low balances and length of history. So don't go on somebody's card that just got it yesterday. You want to make sure that there's history there. And then that can give you a natural boost so that when you do get your credit pulled to go get your own credit, you already have some boost from that, if you will. So if you have poor credit or zero credit, you probably are going to have to get a secured credit card. Now, we certainly have a link that we send out to our people where people will get approved. And the reason that's important is because all secured credit cards are not created equally. What I mean by that, two companies that I know for sure, Bank of America and Wells Fargo, if your scores aren't good enough, they will deny you even for a secured credit card. And now you have an inquiry. So we give people specific link to where you will get approved. So you go out, you get a secured credit card. You're going to have to put probably about $200 down. Typically, a lot of times people are like, oh, I'll go put $1,000 down. No, there's no difference. When you're starting out, there's no difference between that 1,000 and 200. Just do the 200 or 300, whatever you get approved for. Then people think they pay this $200 and it's a credit. That's not a $200 credit. It is a security deposit just in case you default. So they're holding it in an account, like a reserve. And then you have this $200 limit. Then you go out and I say, buy a tank of gas once a month. But you never, ever want to spend more than 30%. So anytime you have a balance at 0 to 30%, that's going to help you positive and it gives you points. 30 to 50 doesn't hurt you or help you. Anything over 50 will take points away from you. And then I like to say anything over the limit's an atomic bomb.
So one of the things you just said there, though, might be a little different nowadays. You made the point that just go get $200, credit limit or deposit instead of 1,000.
Right.
And then I know I used to tell people this, go, fill up your gas tank and then pay it off. Well, filling up the gas tank isn't $30 anymore. It might be $75, $100. Now you're into the 50% utilization rate.
Legit point. Legit.
Should they really actually think about maybe going a little higher, $300, $400, $500, so that if that's their strategy to go fill up their gas tank and then pay it off, that they don't get over that? Because that's important. Like, you don't want to open up a new account to start your credit history and then you're charging it through the month and they report at the end of the month and now you're at 70% utilization. You're not helping yourself that much.
No, you're right. You're right about that. And that's a very valid point. Not the problem. What I see happening is most people that have to get a secured credit card because their credit is poor are usually not in the financial position to get more than 200 because we're usually asking them to get 2 cards. So now we're asking them to spend 400.
Oh, okay.
Right. So if they can get more, that's a valid reason why that would be beneficial. But if you financially aren't in the position, the 200 is fine, and just go get a half a tank of gas.
Or just get a pack of gum at the gas station and just walk to the gas station.
Groceries are fine as well. But the point being, use it for something you're already going to buy. Don't go and use it for clothes. Don't go shopping with it. Use it for something you're already going to, and then pay it off, pay it in full, whatever. That's fine. So those secured credit cards are good. The other thing, Brian, that's good is a credit builder loan. Most people's banks have this. Again, if your scores aren't pretty good, decent, not great, just pretty good, you still might get denied. So we use this company called Credit Strong. And I always call it a glorified savings account. You give them, you go apply, let's say you get approved for $500. They're going to say, okay, Brian, for the next year, you're going to put $40 a month towards this loan. $35 is going to go towards it. $5 is their fee. They're going to make some money on you. At the end of the year, you'll get your $500 back. But the entire year, it's been reporting as an installment line of credit. So just another way to build a thicker credit profile.
Oh, okay.
Okay, so that's just a thought. And then I'm just going to throw this in because I know you probably have a lot of people out there listening that have kids in college, and they want to know, what am I supposed to do to build my kids' credit? I want them to start off on the right foot. Well, you can always add them on as an authorized user to your card, but there are credit cards out there that people with zero credit that are in college don't have to get a secured credit card. They can get a college credit card. Usually starts off with $200, but that way they don't have to put money down. And then I always recommend all parents have access to their kids' login information. So you can make sure what's being spent, but more importantly, that the bill is paid every month. Because one late payment, Brian, can drop somebody's score 100 points overnight.
Yeah, it's dramatic, and it's, people don't get credit education. Like, that's not part of school. It's not part of any education that anybody gets. And I think it's really important for parents to have a grasp on it and then teach it to your kids, because I know way back when I was in college, you got credit card applications all the time. As soon as you show up on campus, oh, you're going to give me some money I can go spend and go party with? Like, sure. But then you get into trouble.
They prey on college students.
Yeah, that's a good word for it.
Yeah. Well, and you're right. And honestly, we owe it to our kids to teach them, because, I don't know if you know this, but I was actually a client first. I was on the other side. I had a really, really bad story in history. And, it had nothing to do with who I was as a person, my integrity, my work ethic, none of those things. It was in 2008 and 2009, and shit hit the fan real fast.
Oh, yeah.
And we lost our house, and everything tumbled down from there. But so people, it's not indicative of who you are as a person either. That's important for people to know, and don't bury your head in the sand. I completely lost my train of thought there, but I think we're just talking about, getting that credit established and building that credit profile. So I apologize if my brain, I started feeling sorry for myself for a minute.
Well, that's what happens when we get old. We can't remember what the hell we were just talking about. Like, mid-sentence, it flies away.
Yeah, 100%. What?
So, yeah. Wait, who are we talking to? So tell me a little bit about the process that you guys do to help people with their credit. Because like you mentioned, like, everybody's gone through it. You said you've gone through it. I've gone through it. Most people have run through some kind of experience in life that I think it's really important what you just said, that it's not about who you are. It doesn't mean you're a bad person. Like, shit happens, and it happens to a lot of people, and you have to learn how to, get through it, persevere through it. And sometimes you got to reach out and ask for some help.
That's right.
Sometimes people, like you said, they bury their head and ignore it. That doesn't do anything. Or they feel ashamed. They don't want anybody to see what's happened, or they don't want to ask for help. And really, there's nothing wrong with it. Like, the whole credit system is kind of rigged against people. Like, it's not set up. There's laws that are there to allegedly protect consumers. And you guys utilize those that are there, but the credit system in and of itself is not there to help consumers. And so when you realize that you're playing this game where you don't actually know what the rules of the game are, like, you're playing on this field, it's like, okay, I think I'm supposed to go here. I think that's the right thing to do. Oh, wait, I'm going to get punished for doing that. Like, you have to ask for help when it comes to credit. So when somebody does need that help, how do you guys go about doing that? Like, what does that process look like? Because everybody thinks, well, I'll just go do it myself.
Mm-hmm.
Like, it's free for me to do it for myself, and why do I have to pay somebody to do it?
Right.
Can you talk about that a little bit?
Yeah, absolutely. So your individual person or your average credit repair company, the process will be to go online, like I talked about earlier, for an individual, or write letters to dispute the debt, right? Nothing wrong with that. Great, go ahead. There's templates out there if that's what you choose to do. There's nothing wrong with it. And there's nothing wrong with credit repair companies that do that. I actually know some amazing people that own credit repair companies like that. But there's just not a lot of teeth behind it. There's not a lot of leverage, if you will. So what we do different on our clients' behalf is, first off, we'll do an initial overview of their credit for $1 for the first 7 days to get this credit monitoring site. But what it does, Brian, is it allows us to get a plan together with them, right? To walk through the credit report with them, to teach them things that they could do on their end while we're working on our end. So we do that overview with them. And then if they decide to move forward with us, what we do different is we actually send out, we work together with attorneys, and we send out a limited power of attorney. People get all weirded out. They think that we're going to be able to get into their banks and their medicals. No, it's limited power of attorney that only allows us to speak to their creditors. But what that does is that's what gives us our leverage, because now they're like, oh, they're actually working with attorneys. So when we ask them, we go to them and we say, okay, collection company or creditor, we need you to give us our clients, original paperwork and validating the debt and proving the debt as the client's, and report with 100% accuracy. And if those things aren't done, then that's when the attorneys that's where that attorney relationship leverage comes in, because we can be more aggressive with them. So doesn't mean we're going to get everything off. If these companies validate the debt and report with accuracy, nothing we can do. But it's getting enough of it off, because you don't need somebody to have a pristine credit report to get them qualified, right? You just need enough stuff removed. But the other part that people really love about us, and I know that's probably one of the reasons you're comfortable referring to us, is the fact that we are paid for performance, meaning we only charge you for the negative items that we get removed. So we're super, super highly motivated. Like, you wouldn't take your car to go get fixed, take it to the mechanic, have them give your car back and be like, you got some stuff wrong with it, but I really can't help you. But you paid me $1,000. You would never do that.
Yeah.
Right. So it's the same idea. We want to fix it the best we can. We want to help you the best we can. You're going to pay us for the items we remove. We're going to educate you. You do your part. We do our part. Somewhere in the middle, we're going to meet and get them back to you for a loan.
Yeah. I think the analogy we always use with clients, like, there's some things that you can do self-serve. And a lot of those things are things that we can tell them from looking at their credit. If it's a simple pay down on a credit card balance, I mean, you can do that yourself. But there's certain things that are a little bit more complex. You don't know the rules. Like, you wouldn't hire or you wouldn't say, oh, wait a minute, I need knee surgery. I'm going to do this myself. I think I can handle it. I mean, I've got Google, like, I can Google stuff, shit's not that hard. But like, you need to hire somebody who's a professional to do certain things in life. And, I think that's the biggest thing that I can tell people about the whole credit game is you don't know the rules.
Right.
Like, you don't know what the rules are. Like, you're navigating blind through this process. And there's a point at which you can't really be effective doing it on your own. You need to have that leverage of somebody like you with the attorneys that you guys have to help to get these creditors to understand, oh, these people might actually know what they're doing. We got to follow the laws. And that's where, like, when they're forced to follow the law, magically, a lot of times, this stuff disappears because they weren't able to do what you guys asked them to do.
You got it. Absolutely.
You want to buy a house, but high interest rates have got you down? Take the rate challenge and send us a verifiable loan estimate from another lender, and we'll beat it and pay for your appraisal up to $600. Here at Give Mortgage, being powered by U Mortgage allows us to provide you with unmatched speed and efficiency and the best rates and fees in the market, all while delivering you the concierge level service you deserve. We want you to have an experience getting a mortgage that you'll never forget, and not because you got put through a meat grinder to get it. At Give Mortgage, we give great advice, we give the best rates, and we give back to charity. Visit us at www.give-mortgage.com or call us at 480-331-4684 to schedule a free consultation to see how we can help.
So one other thing that I wanted to ask about, because it's being talked about a lot, and I pay attention to the extent that I need to pay attention to it, but I'm not educated on it as much as I should be, and that's student loans. There's all this talk about student loans and how student loans are just a burden on people, and it comes up on people's credit a lot. Where there's negative reporting history, and then you hear things about, well, how can you make it better? Can you get rid of it? Can you kind of give us the big lowdown on student loans?
Yeah. Student loans, if it's with a government loan, will never, ever go away. So you're just going to have to dig in, contact them and get a payment set up with them. But there's options there, right? It's not just picking up the phone and saying, okay, well, you got to pay $500 a month. Well, most people can't afford that first phone call of when they say what they got to pay. So there are programs out there. So if you're in default, there are rehab programs, and we have a company that we refer out to that does this rehab. And if you pay your so first off, they'll get you into 1 year program, the first year, and it's typically like $5-10 a month. I mean, it's super cheap for the first year, and that gets you in this rehab program. And then if you pay for 9 months, perfect, no mistakes, they'll actually remove all the negative that you had reporting on your credit report. If you miss one payment, the whole rehab is wiped out and you can never do rehab again.
Oh, wow.
So it's a great benefit and it's important, but yeah, you can't mess up. So then after that first year is over, Brian, then what they'll do is they'll revisit. And then your payment is going to be based on your income. So if you don't make a lot, your payment will still be low. Now, if you make a shit ton of money, then yeah, they're going to ask you to pay more money. But also they'll evaluate it once a year. So next year, you're not making a lot of money this year, but next year you become a doctor and you start making a bunch of money, they're going to ask you to pay more money.
Yeah, you should expect to pay it back when you make a lot of money. I think sometimes, that in the society now, it's like, the expectation is, oh, I got a college degree. Oh, I got myself into $80,000 of debt, but now I make $40,000 a year and I can't afford to pay it. Can someone else come in and pay it for me? Yeah. Like, sorry, I didn't sign up for that.
Still got to pay it. So then that's the rehab program, but there's lots of repayment programs. So let's say you just want to consolidate it. Let's say you have you've done rehab and you can't do it again because I already told you there's rules to that. And so you just want to consolidate it. There are programs that you can just consolidate it down to one payment. Because what happens is like you get a loan per semester, right? And let's say you go to school 6 years. And then so all these semesters are on there. And then let's say you have 12 semesters and then that gets sold. And there's another 12 semesters, right? So then now you see this credit report with pages and pages and pages worth of student loans. Well, so if a student loan, let's say they had some lates and it was transferred, then we would work on trying to get all those removed because those late payments are affecting you. But if you have student loans that are in good standing, we're not going to do anything with those. But if you want to get into a consolidation program, there's companies out there. Again, we have one that we refer to, and they'll put it all in one loan. So not only does it look better on your credit report, it's easier to pay. You don't forget. And so there's a big benefit there too. Now, if you have two things. So if you have a student loan that is with a private student loan, then that will actually fall off after 7 years. So I'm not saying don't pay your bills. I'm just saying it does fall off. And then the other thing is, and this is important, is let's say you have a client that their school went out of business. There's programs for that. Or you're in school and your specialized program or degree was discontinued. There's programs for that. So there are ways that you can fight that as well. I think it's like a 21-page application you got to fill out. So they're going to want to make sure that you are serious about it, but there are options to help you.
So yeah, they're going to make sure you actually got enough of an education that you can fill out a 21-page application. You got to earn your way for some help, I guess.
Right. That was your extra education.
So the thing with student loans, the differences between the government ones versus private companies, aren't the private loans tend to be a little bit lower interest rates than the government programs?
No. I've seen it both ways. And my son, for instance, he has private and government. He has both. And it really depends on your credit scores.
Okay. Yeah, I think I was talking to somebody before, and they're dealing mostly with dentists. And so I think the pluses and minuses were the ones that they were doing. The rates were better on the private loans, but then you don't have all of the protections that you have with the government loans that everyone has experienced during the COVID pandemic, is getting, payments put on hold and the interest doesn't accrue. You don't get that stuff with the private one. So there's always pluses and minuses with all that stuff. One other thing I wanted to touch on too, that we hear all the time is, people say they want to get qualified to buy a house. but I don't want to have my credit pulled because I don't want an inquiry. I don't want to hurt my credit. Can you kind of talk a little about the inquiries and the real impact? Because I just had somebody tell me that she had to drop 100 points, and I was like,
Nope.
It didn't happen, but
Right.
I know better.
It 100% did not happen. I always like to say inquiries don't hurt you nearly as much as the internet would like for you to believe. Yes, they can affect you. There's no doubt about that. First off, when that person said you dropped her score 100 points, or somebody dropped her score 100 points, she was probably looking at Credit Karma, which is already higher than your real scores. So let's say on Credit Karma, I have a 640, right? And you pull it and it says I have a 580. You just dropped my score 70 points. No, those were not your real scores. So that's the first thing. But absolutely not. You can have 10 inquiries in a 12-month period, and it doesn't negatively affect you. Everybody has that right to be able to shop. But there's a specific clause in mortgages called the right to shop when it comes to mortgages. That let's say you have a client that went on to an online mortgage company, and they were referred to you by a realtor, and your realtor was like, no, don't use that online company. You've got to go with Brian. He's my guy. Well, they don't want their credit report pulled again because they think it's going to negatively affect them, but they can have their credit pulled by as many mortgage companies as they want in a 14-day period. And it only counts as one. Now, I will tell you, auto pulls are supposed to work the same, but they do not code it properly. So if you go shopping for a car, let's say you go 3 different places in one weekend, you could easily have 45 inquiries, and they count as 45 inquiries. So it is important if you go car shopping. I always recommend credit unions, but let's say you do go car shopping, then making sure that you tell both the salesperson and the finance manager to not run your credit through more than 2 people. And so then that protects you from having all those inquiries on there. Inquiries also only last 2 years. So it's not like they're going to stay around forever. And we always tell people, again, they're not hurting you that bad, but it's all about the overall credit profile. So if you build your credit and have a nice, strong credit profile, then it'll balance it all out. And so then we go tell people, all right, go open this credit. But you just told me not to have more inquiries. Well, yes, the price you pay for a couple of inquiries is nothing compared to the benefit that you'll get by having established credit. And then again, they only last that 2 years. So I hope that helped. I went a lot of places there.
Yeah, I think the thing that, tell me if I'm wrong, but this is what I always tell people with that is just like you do, you need to know where you're starting from, because your Vantage score isn't going to help us. We need to know what your mortgage FICO score is. And then whatever that happens to be, that impact of that credit inquiry is generally pretty small. I mean, I usually experience it to be less than 10 points, usually like 4 or 5 points.
Yes.
And so when you have that inquiry, I always explain to them what that reasoning behind the decrease in the scores is that, if you went to Target and you're in checkout and they offer you a Target card 10% off and you say yes, well, now you have an inquiry showing up on your credit report. And then I go pull your credit that same day or the next day and see, oh, you got a credit inquiry from Target, but I can't find a Target account anywhere because it doesn't show up immediately. So the scoring model is reflecting for the added risk that there might be a new debt with Target out there that we don't know about yet. But once Target starts reporting 30 days, 45 days, whatever that takes for them to get it on the credit report, now the impact of you actually having that credit account with Target, whatever balance you have, is now reflected. And so the impact of the inquiry now goes away because that unknown is now a known quantity. So even if you do have your credit pulled, today, and you don't go forward with something, probably in about 60 days, generally speaking, the impact of that 4 or 5 points you lost for the inquiry is now gone.
That's
is that
correct.
on target?
Yeah. I mean, unless it's a car situation, even if you have one car, it's not going to balance out 45 inquiries. But overall, yes, they will shift out. Yet it hurts right now. And also that new line of credit, let's say you get that Target line of credit, that's also going to hurt you for a short period of time. but it all is going to benefit you long term. So it's worth the inquiry. It's worth the new line of credit that we're asking you to open. But of course, again, lines of credit aren't always great if you have too many, because then you become a risk, and you don't want people to go, let's say, shopping after they get their credit pulled, because then that again goes to the risk aspect that you brought up, that the underwriter is going to say no because you have too much credit.
Yeah, so don't go buy all of your furniture before we close on your mortgage loan and charge it all up on your credit cards.
Right.
Yeah, so I think the other thing that comes up a lot is, people look at their credit reports and they see stuff that's incorrect. And a lot of people have experienced some kind of, fraud, people having their credit taken over. Like, what kind of stuff can people do if they experience something like that happening to them?
Yeah, that's important. And that's why it's very important to always have a credit monitoring site. They're like Credit Karma. There's nothing wrong with that. I'm not bashing them. It's a free site, great to have, but it only has 2 of the 3 bureaus. So you really want to have one where you can see all 3. And it does protect you, that you can track what's going on. Even if you're not paying attention to the scores, you're tracking the body of the activity. And then you'll get alerts and stuff from them as well if things happen. But above and beyond that, if you want to protect yourself, you can do 2 things. One that I recommend is going to be a fraud alert. So you would contact the credit bureaus directly and have that fraud alert put on your credit bureaus. And so anytime if somebody would apply for any type of loan, it would contact you and say, is this you? Do you approve it? Yes or no? The other thing you can do, but you just got to be really kind of weary about this, is putting a freeze on your credit. So the freeze, if you do that, never, ever, ever, ever lose your PIN that they give you. Because if you lose that PIN, good luck getting that unfrozen.
Oh, wow.
You might have to sell your kids. But unless you want to sell your kids, then that's different. But it's very difficult. Also, let's say they have a freeze on there and you pull their credit, you can't get their credit scores. So then they got to go back, unfreeze it. You got to pull it again. And so I don't encourage the freezes unless you have active fraud right now, then that would be the reason you might want to do it. But let's say they do have fraud. Well, there are 2 aspects. Okay. Let's say they have an account on their credit report that's just not theirs. They don't think it's fraud. Maybe it's their dad's because he has the same name, or somebody else with the same name in the same city, because that could happen. So you don't necessarily think it's fraud. What we have our clients do is we send out an affidavit of fact with a statement. And it's a notarized document. So it's a legal document, basically stating that this is not my debt. But for identity theft, we recommend that they go get a police report. And then there's an identity theft affidavit also that they can fill out. It's about 8 pages long. So they really want to make sure that it's legit. And it has to be notarized, so it's a legal document. But the police report is the important part, because what happened, Brian, is, well, it still happens. I don't know if it happens anymore because they caught on to it. But credit repair companies, I don't want to say companies, I'm just saying really crappy people, they would go claim identity theft on their client's behalf. And then automatically the credit bureaus by law have to do a dispute, right? They have to do an investigation. So they suppress all that information. So it's suppressed for 30 days until their investigation is done. So your scores do go up.
Oh, wow.
They're going to go right back down after all that information gets back on there. So then they started requiring that police report to have any type of teeth behind it or legitimacy. And so that also helps us know when our clients are legit and they're serious. People aren't going to go take that time to go to the police report and fill out an 8-page legal document unless it's legit.
Right. So what about, because we've heard this in the past, and I haven't heard it too much lately, but some credit repair companies, if you want to call it that, say, oh, you have a bankruptcy, you have a foreclosure, or you have a judgment, you have this, that. Oh, we can get this all taken off. Like, does that happen? Is that legal? Can you tell me about all that kind of stuff?
Well, well, judgments and tax liens they don't report to credit reports anymore. Bankruptcies still do. And anytime any credit repair company guarantees they're going to get something off, run as fast as you can. There is no guarantee. And the guarantee, again, is kind of what I just said. They will file that police report or file that identity theft. And then they, by law, have to suppress all that information. So they are telling you the truth. They'll get all that removed. They just don't tell you that it's going to all come back on. So if anybody guarantees something's going to be removed, no, you wouldn't want to hire them. There are options like a pay to delete, which is a guarantee of removal. But that, like, for instance, we work with a few hundred companies that will do that because of our relationships with the attorneys. So if the client does pay the debt off in full through our legal team, then we can get it. So that would be a guarantee, but it's a guarantee because you're working within the system, not because I said I'm going to get it off.
Yeah, I mean, it should kind of clue in for people when you hear somebody telling you, I can get a public court proceeding removed from your credit report. It's like, that sounds wrong. Like, get a clue. That's probably not correct. Right. But the pay for deletion that you brought up, I think that's, I'm glad you did, because that's something that is a super helpful tool. And it goes back to what you said earlier, like people have something come up, a collection on their credit report and think, oh, well, let me go pay this off and that'll take care of it, not realizing it's going to hurt them. But also, if you do that, like, you eliminate all your leverage to try to work with them on a pay for deletion. And sometimes you can even get the amount reduced that you have to pay in a pay for deletion as well, right?
That's right. Yeah. I mean, there's thousands and thousands of creditors, and I would say 10% of them probably do pay to delete. Maybe up to 20 at this point in time. A lot of them are getting, smarter, and they're like, okay, well, this gets us our money. Why wouldn't we do this? But there's actually a signed agreement between collection companies and the credit bureaus not to delete with payment. But companies still do it. They're smart to do it because they're going to get their money. But it does take away that leverage. And if you go and pay it, then we can't call them up and say, hey, will you delete it? That's gone. And then if people do reductions, I would say it's usually never more than 20% for a pay to delete.
Yeah, I mean, you're getting the benefit of getting it deleted. So even if you have to pay the full amount, there's a huge benefit there to, it improves your credit, it improves your scores. And then if you really just want to quantify it, because somebody might have a $300 debt that they need to pay, and they think, God, that's a lot. Well, if you look at what the improvement is on your score and then turn that into what impact on your interest rate and your payment is, that what you'll end up finding out in most cases is you're going to save a lot more money in the long term by doing that. Even if that $300 debt payment, hurts a little bit today, it's going to be a big benefit to you in the long term.
You're absolutely correct. And I'll tell you, not enough lenders use that as education to their clients and break that down, the amount of money. And we're not talking, oh, you pay this $300 debt, you'll save $500. No, you'll save tens of thousands of dollars on the term of the loan to put a little bit of time, effort, and money up front.
Well, and it's the same thing, not just on a pay for deletion, but it's using services like yours. Like, I don't want to pay for this, it's going to cost money. Okay, yes, it's going to cost you money, but what do you get back out of that investment that you're making? Don't look at it as an expense, you look at it as an investment. If I can invest in this to improve my credit, like the thing that we can do is when we pull your credit, we can simulate these things. So a lot of times we'll go in and say, okay, well, if you can get these three things, removed and pay these things down, what have you, we can see roughly what your scores will look like afterward. And then we can show you, here's the impact on your interest rate, here's the impact on your payment. And definitely, when you look at it over the long term, it's an investment that's going to pay off, tenfold at least in the long term. And I think people just have to wrap their heads around, it's not an expense, it's an investment that's actually going to save you money. And when you see it from that perspective, it's like, okay, I'll get some help from a professional so I can save some money. Absolutely.
And it's not just on the interest rate of the home. People can save big time on their car insurance. And that's a factor. 60% of employers look at it. When you get you go for a cell phone, Your rate is based on your credit as well, so you might pay higher fees, if you will. One thing that people don't recognize is that in the military, to get a rank increase, you're graded on your credit, or to get security clearance, you can be denied. And I only know these things because I have family in the military, but I also have clients that come to me and are like, oh my God, I'm up for this security clearance. I can't get it until my credit's fixed. And so most people just don't know that.
Yeah. And that has mostly to do with you being in a financially compromised position, to where someone can leverage you, for information because of what they see that, is out there. So
Right.
It makes sense, but people just don't know that kind of stuff. That's why I love to have, people that really know what they're doing, like yourself on here to educate us all. And I appreciate you taking the time out of your day to join me. If somebody needs your help, tell our audience, how do they get in touch with you?
Yeah, absolutely. So they can, our website, they can check us out there. It's www.rescoreyourlife.com. And then if they want to shoot us an email, it's info@rescoreyourlife.com. And then, rescore spelled like that. And then a phone number is 816-683-2900. And then any of us that answer can help you out and connect you with one of the credit coaches on our team.
Awesome. So if we do sign up for your service, do we get one of those cool green neon pens too?
Yeah, you bet. I got it in blue as well.
Cool. Well, I appreciate again, Paige, you joining us. And I hope this information was helpful. I know we covered a lot of stuff today, but I think it's all stuff that really does impact your life in a lot of different ways, like you just said. And I can't thank you enough for joining us today. I appreciate it.
Absolutely. Thank you, Brian. And appreciate you having me on very much so.
All right. We'll see you guys next time on our favorite broadcast, right? Uncensored Real Estate Podcast. Take care.
Take care, everyone.
Thanks for joining us. And please remember to go and subscribe, like, share, all that cool stuff to help us grow. And come back tomorrow to listen to our next episode. Until then, go out and live life uncensored.
Thanks for listening to the Uncensored Real Estate Podcast. Don't forget to help us out and subscribe. Follow and give us a 5-star rating on your favorite podcast platform. And check us out on YouTube for the full video podcast. If you want more information on any of the topics discussed on today's episode, email us at uncensoredrealestatepodcast@gmail.com or give the Cardenas Mortgage Team a call at 480-331-4684.